Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have the EIA show a little bit later because I was up in New Hampshire actually looking at some dams that we are going to potentially buy with 3 power plants. So it's 4 dams, 3 power plants. So it was always interesting to see what's happening up there and got to drive around and see some beautiful areas. But now back to the fun stuff. And one of the things that we have been talking about is that gasoline demand in the U.S. is at 9.1 million barrels a day. We've been saying that for a very long time. You know, we thought it was going to be 9.1 to 9.3 and really averaging closer to 9.2. But then as we got into June and things never really got to where we thought, we had taken it down to about 9.1. And again, you're going to average it. And as I've tried to explain, when you look at the EIA data, it's always lumpy. It's always going to be lumpy, especially when you look at the demand side and in the export side, based on just how the filings are, how the data is processed, which is why as we go through this, especially in segment 2, we use other data sets to either confirm or take away kind of what we're seeing. And that's why it's so important to look at so many different data sets to get an idea of, okay, well, what is real? What is just a bit more noise before we see the true number? So in segment 1, we're going to go do a brief overview of where things sit, looking at the different components. Then we wanted to look at the demand side in segment 2. Where is the U.S.? Where are we sitting? How are we progressing into shoulder season? And then we want to look at on the global side because we're seeing more and more pressure on the demand front, especially as we look at Central Asia as well as Europe. So that's what we're going to cover now. So we get to jump right in. So here's where we always look at that global number on the total oil and product stocks, which have continued to creep higher, which is, again, not going to change. But if you look at that pink line, that 2021 line, how you can see it has a downward trajectory, and right now we continue to trend up, that's not going to change. Again, we see this continuation as we head into the end of the year, especially as you have holiday season ending for many. For those that have kids in on the West Coast and in the South, typically school starts next week. In other parts of Asia, especially the ASEAN nations, you're starting to get something similar, where by the 3rd week of August, kids are back in school. So we're coming to the end of that peak season. Obviously, Labor Day is, that unofficial or official end of summer, but typically things start to slow down now, and it just gradually continues into the the beginning of September. Then when you look at total crude stocks, land and floating, you can, again, look at that line, how it normally dips down from the 2017 to 2019. You can see that there's that normal gradual move down that happens until you get into the middle of September. But here you can see, as we've been saying, is we're just going to go sideways. And if you remember from what we were discussing at the beginning of the summer, was that the comps were going to get easier because the data was telling us that land and floating storage for crude was just going to go flat. Maybe creep higher, but it was really just going to be flat as the rest of the world continued to, in historics, to move along historical norms, which is when you have a drop in crude in storage as you come into the end of September. But here you can see that for the blue line, 2022, we just didn't really get that. Now on the total oil product stockpile side, you can see things that have flattened off for the most part. The deficit widened slightly, but one of the things that is important here is what is driving that, because middle distillate continues to be the driver as gasoline on a global level continues to surge higher. Now, it's important to talk about on the deficit side. So total oil and product stocks, the deficit narrowed from 78.8 to 65.2, but it was driven by crude, where the deficit narrowed from 22.2 to just 7.8. And that's something that we do see continuing, especially when you start looking at what is happening in China. So China's state-run oil refiners and teapots in Shandong have trimmed their crude processing rates in the week ending August 6th, so the end of last week. And after a resurgence of COVID-19 in some places, you're starting to see some additional lockdowns. So there's a concern that, again, you're going to get some of the slowdown coming into China, where they already have over 1 billion barrels of crude in storage, which is why we do continue to see some of those headwinds. Now, on the land side, specifically speaking, you can see the deficit narrowed from 56.8 to 53.9. And again, look at that 2021, that the pink line, as well as that dark gray line that normally comes down. Here, we're going to continue to see that drift higher. Land storage west of Suez, same thing. Things are getting a little bit easier, which is what you can see with the deficit, where the deficit isn't really narrowing because we're getting this huge surge in 2022. It's because the comps of previous years are just coming down on their normal seasonal declines. And here we're just not getting that. With the same being said in the east of Suez. So the west of Suez and east of Suez is going to be interesting. And we want to talk, especially in segment 3, about the builds that are happening in the Middle East. So now when you look at floating storage, the surplus widened from 29.4 to 39.3, and a large part of that was driven by the Middle East. And again, I think that's really important when you look at the OSPs that were laid out and where storage is, which is one of the issues we called out, where if Saudi Arabia raised OSPs aggressively, which they did, it was going to result in additional floating storage, which has already come to pass. So that's when you look, we're tracking 2021, continuing to remain at that elevated level, going from 29.4 to 39.3 in storage. But west of Suez flipped. So and the west of Suez flipping was really driven by the West African crude grades, which have seen a continuous decline in pricing to incentivize, which the flipped deficit went from a surplus of 1.9 to a deficit of 9.2. But it wasn't enough to offset the big surge in east of Suez floating storage with the surplus going from 27.6 to 49.1. Most of that on the back of what is happening in the Middle East. And one of the side pieces in terms of some of these flows, Russia resumed oil flows through a pipeline to Central Europe after Hungary's sole refiner stepped in to resolve a tussle over the payment of the transit fee. And that's where you're going to continue to see some of these different pieces because again, it's a cost issue. It's a matter of how much of this can they try to bring in prior to the solidifying of new sanctions that are supposed to come in by the end of this year. Now, flipping to the U.S., there was a build of 5.46 million barrels, the 41.2 million below the 5-year average. But again, we always call attention to where is this shortage, and it remains in PADD 2 and Cushing. They did have builds. PADD 2 was up 1 million, Cushing up 720,000. And you're seeing some of that gap closing, especially on the 5-year average, just because as we've been saying, as things you normally have these drawdowns, but yet we're starting to get a little bit of these builds. Gulf Coast had a build of 4.68 million, right in line with the 5-year average. A pipeline was just shut down, a Shell pipeline, which will throw a little bit of a kink in terms of what is happening at this point, because multiple Gulf of Mexico oil fields are shut after pipelines halted. Shell's Mars, Ursa, and Olympus oil and gas fields, as well as Chevron's Jack and St. Malloy, Tahiti, and Bigfoot facilities in the Gulf of Mexico have been shut. And it's just because the field shut in after a flange leak at the Fortune Booster Station in Louisiana prompted Shell to halt its Mars and Amberjack crude pipelines. So that will hit in terms of how much PADD 3 it's going to, but again, how much is it going to hit is going to be indicative of how quickly can they fix it, how big is the problem, are there some workarounds, and that will also hit production. So you can see production increased to about 12.2 million. That is right where we are. So the question is going to be, do we get one more push higher in production as we head into the end of the year? And that's going to be a question coming up in terms of how we reevaluate. But it's something that right now we're comfortable with 12.2. If you remember at the beginning of the year, we thought we could get to 12.2 being the floor, 12.4 being the elevated or the ceiling. It's going to be difficult to get there, just given how slow some of the small frac spreads have been in the smaller basins. But that's something that we're going to cover more tomorrow. But again, that production number will go down this week or into next week. Now, when you look at runs had a big spike of 3.3% on the utilization rate side. That's an increase of 728,000 barrels. And again, a lot of this is being driven, as we said the previous week. Pad 3 was going to come back. Some of this was down due to maintenance, some unplanned downtime. But now you're seeing this one last push until we get into the end of the summer, where then we start to see those ramp downs as we already have scheduled maintenance. And again, you're coming into your normal slow period, which is the shoulder season, which is typically, the second, third week of September into the last week of October, first week of November, depending on when some of that maintenance is ending. And here's where you can see, obviously, some of those big drops in September were hurricanes. But even with that big increase in utilization rates, you can see that we're still slightly below normal. So when you look at it over the last 5 years, we're about 2% above where we normally are. But when you look at previous years, 17, 16, again, we were typically closer to 95, 97%. So we're still very comfortable with that. And then you can see that there's that normal drop as you get to the first week of September. Balance, really getting to the lowest end, again, taking out the hurricanes, getting out to the end of September, and then starting to see that slow grind higher, flatlining in October, and then starting to increase until you're getting ramping up as we get into November and December. Imports were down 1.17 million barrels a day. That's 886,000 below the 5-year average. And again, it's the lumpiness that we've been talking about. So Pad 5 had a drop of 396,000, still above the 5-year. That ebbs and flows. Pad 3 had a drop of 461,000. This is a bit more of a timing delay. We do see this increasing next week, and we'll show you why. Just because the floating storage has come down. So because it's come down, it's got to go somewhere, and we do think that you'll see some of this show up. It's just a matter of when is it filed. And then Pad 1 had a drop of 325,000 barrels a day. But then Pad 2 had an increase of 559,000, which is Pad 2 is where we continue to see a bit of that grind higher as we go into next week. And here's that import into Pad 3. We were expecting a little bit of a grind up. Here you had that drop. So we do expect that bounce, right back to the peak in which we were last week. But you're still seeing that we're well off the 5-year, and we don't see us getting back there just because of the limitations that we've described on the refining front and just what crudes are available, because they really want to maximize that distillate cut given the shortfalls that remain pervasive in the market. So then when you look at Pad 2, here you can see imports into Pad 2 right back to the 5-year average. We expect it to remain right at the 5-year, just above, but again, just slightly above in that top end of the cloud, just given the production needed, because a lot of this is obviously coming from Canada, which has a very healthy distillate cut, which is where the biggest shortfalls remain in the industry. Implied demand, gasoline had that increase of 582,000 barrels a day. For those that follow us, that isn't a surprise. And you'll be shocked to know it came in at 9.12 million barrels. And for those that have been following us, we've been saying 9.1 million is where we should be. As we said last week, 8.5 is too low. We thought there was actually going to be a little bit of a bigger increase, closer to 9.2, 9.3. Instead, it only came in at 9.1. So we do think there's going to be one more step up to about 9.2 million, because you have to have a little bit of that catch up, because this is looking at supply. So it's implied demand looking at where supply is going, and it stops at where the blending stations are. So that this is right before it gets put on the truck that then gets sent into the market. So if you get a week where a lot of the corner gas stations didn't buy that much, or there's some timing delay where, it actually slips into the following week, which is why we've talked so much about how lumpy this is, and why we talk and focus so much on the 4-week rolling average, which is what we kick every single segment 2 off with, because it's very important to look at where is the trend. Distillate continues to weaken. We don't see that changing. As we said last week, it's going to stay right in this level just because, again, we're not getting a lot of trucking demand. Trucking demand is starting to flatline. So, again, you're starting to see some of this normalize, but it's not going to go back. Maybe we get one more week above 4 million. And then we come firmly into shoulder season, and then we'll get that pick back up for heating oil, which is what we're going to talk about the most when we get into segment 2, because we are still very well below where we should be, especially in pad 1. And that's where we're going to get most of that pressure, because that's where a large part of heating oil is consumed. Jet fuel bouncing around, above where we think the trend is. So again, our trend remains 1.45, 1.55. So we will see that drop. Propane fell 140,000 barrels a day, but still a lot of strength going forward in the international market. And here's, again, the lumpiness. And you can just look at the historical data, and you can see the gigantic swings that continue in this system. Like, I don't really understand the view of their lying. I've been following this data since 2006. It's been lumpy as long as I've seen it, and it's always been like, oh, well, that's below what we know to be, so it'll increase. And I love it when people talk about anecdotal data. So now just to throw fuel on the fire, I have now been, I think I was counting, I've been in 11 states, about 40 different cities over the last, let's call it 2.5 weeks. And I haven't seen a lot of traffic. Now, I can say that, because I haven't seen that traffic, therefore gasoline demand is low. Well, I don't normally drive these roads. Like, these are trips that I've taken for work, and I'm driving on them and they're empty, but were they more empty prior? Are they busier now? I mean, I was on some country roads where if you saw 15 cars coming the other way, that was surprising. But is it normally 10? Is it normally 15? Is it normally 27 or 30? And I just say, again, like, that's why it's so hard to do anecdotal, especially because it's like, well, I was in rush hour traffic. It's like, yes, there's supposed to be traffic then. It's where is there traffic otherwise? Let's look at the national average. Let's look at miles driven. Let's look at TomTom. Let's look at Google Mobility, things where they're tracking millions of phones, hundreds of millions of phones. That's how you're going to get an idea. And again, this is just one data point. So I think everyone has to just take a little bit of a deep breath. Not everything is some weird tinfoil hat situation, but just understand that this is lumpy. It'll stay lumpy. It'll be lumpy next year. It'll be lumpy the year after that. That's just the way this data goes. So now when we look at crude oil inventory, you can see it continuing to grind up. We're at the highs for 2022. And when you look at just total crude oil inventory, we do expect this to continue to move higher. We do see exports increasing. Exports were down 1.4 million barrels. Again, just as we think imports were artificially low, we think exports were artificially low. And similar to what we talked about on the gasoline side, those are lumpy. When was it filed? When was it deemed left? Did the EIA office get it on Monday? When did it get filed by the company? So again, like, you have to keep this where we're looking at the 4-week average. What is the trend? Where are we going? Because there still remains demand for U.S. crude. So do I think we actually exported 2.1 million barrels a day of crude? No. Do I think we exported something closer to 3.4 million barrels a day? Yes. But it's not in a straight line. It's not linear. That's not how this data works. So that's where that's why we do the show, because we're trying to give guidance on, look, this is what the data said. It's noisy, but this is what it means. This is the trend. This is the data. This is the other pieces of data we found that it gives credence to, we are moving in a good direction. We are getting a bit weaker. And that's hopefully that has been helpful to you as the viewer. Days of supply for crude, you can see it went up. This is again a week lag. It will go up again, even though we did have a sizable increase in runs, and it's just because we had a bigger build in crude. So when you factor in the SPR, we only had a build of 160,000 barrels. But again, runs go off of commercial, which is why we try to keep those together, especially on the days of supply, which goes off of commercial, not off of SPR. So that's why we, again, trying to keep the data consistent. U.S. commercial oil storage and products, as we've been saying, sideways, slightly up. Right now we're tracking where we were in 2018. We don't see much deviation at this point. We do, again, gasoline is that movement in terms of, we had an increase into the market. We had a decrease in storage, and then you'll see that moderate, which is what we were discussing, where when you look over the 4 weeks, we do expect gasoline storage to continue to creep higher, which is where here you can see that, again, looking at 2021, looking at 2013, you normally get a drop. You can see just in terms of where that drop comes in, we normally draw down capacity into the end of September. What we're saying is that we're not going to do that. We're going to go sideways. And that's where we've been saying it's going to be sideways, but it's not just, it's going to be this pretty line. We do think it's going to be more normal, more steady than normal, but it's still going to have some fluctuation in it. And if you average it out, it's only going to be a build or a draw of 160, 250,000 barrels from storage, just because you have those movements up and down. What did the refiners do? What did they export? Here you can see production for gasoline was down. It broke 60%, while production in the distillate side remained fairly healthy. And again, it's just they're trying to minimize gasoline because yes, there's space here, but when you look externally, globally, gasoline storage is a huge problem, and you want to try to avoid that, especially when it comes to having to roll out economic run cuts. Distillate had a small bounce, increased of 2.17 million barrels, but you can see we're still well off of where we should be. Rate of change isn't keeping up, and that's something that is going to be more and more of a concern as we transition into the winter months. Yeah, jet here, fairly normal. Not much to say one way or the other. It's going to be a matter of how much stays in the kerosene pool, how much goes into the kerosene pool versus staying in the distillate pool, which we continue to see. Now, when you look at the curve, as we've been saying, the front of the curve is very volatile. For those that read what we talked about in Anas's report, we expect it to be, let's call it about 102, 103 on the Brent average side for the second half. That doesn't change. Right now Brent is at 99.59. We see upside to that number. But again, when you look at this curve, which is the WTI curve, you can see, as we've said from the beginning, the front month is going to be very lumpy. But there's a lot of opportunity in the belly of the curve, and you can see the belly of the curve continues to strengthen, getting stronger even against previous curves and previous weeks. Crude oil inventory in Pad 3, we're now right at where we were in 2021. You can see that the only times we were higher was in that 2016 period and obviously 2020. So again, as comps go, we're above the 5-year average. If you take out that odd year, which is that yellow, which yes, was COVID, was 2020. So there's really no concern about crude in Pad 3. There could be, and very well is, a concern about the type of crude, because again, we want the distillate cut, minimize the gasoline cut. But in terms of as physical barrels go, everything is very normal in Pad 3. If anything, probably slightly above normal when you're looking at the Gulf of Mexico. Storage and Cushing continues to drift higher. We had said that it's going to move up. We didn't expect this huge shift in rate of change, small adjustments, and again, up 720,000 barrels. And we just continue to see that moving up. Now, how much of that is going to be impacted based on the disruption from the pipeline? could be sizable. It again depends on how quickly it comes on. So we should see a draw, but that's going to be something that we'll look at in terms of what are going to be the impacts to production, and again how quickly it comes back. And then here you can see floating storage moving back down, which again is why I think the export numbers are understating, because if you get this drop in floating storage, usually means it got pushed on shore. So one is showing it did, the other saying it's not there yet. Again, some of that timing delay, which will get cleaned up over the next few weeks, will come about. So that's what we have for you on the overarching picture. In the next segment, we're going to go deeper in terms of the U.S. demand and how we see this shaping up into the shoulder season.